Hello, everyone. So, in today's video, we are going to talk about the differences between index funds and mutual funds. Now, when it comes to index funds and mutual funds, they are essentially the same concept with some minor differences. And so, I did a video, I think a short, a couple of weeks ago, where I talked about if you are someone who is really busy or a busy professional and investing makes you feel a bit overwhelmed and you are kind of intimidated of trying to pick the perfect stock. Index funds and mutual funds are a great way to invest in the market, have a diversified portfolio, and takes the pressure off of you of trying to find the perfect stock. And so, this is why I do highly recommend index funds or mutual funds if you are trying to simplify essentially how you invest. So, when it comes to index funds and mutual funds, they are basically like a little basket of stocks, a mini portfolio, if you will. Let me see if I can find. That's not it. I'm trying to find this picture. Here we go. Let's make sure everyone can see. So this is a very basic depiction of what an index fund or mutual fund funds are. And so they are basically a mini basket, or I like to call it a mini portfolio of stocks of different companies. And so you will buy this index, and by doing that, or mutual fund, either or, when you invest in them, you now have pieces of all of the companies in this mini portfolio. And so this can be a great way for you to invest in many industries, many companies in a very simplified fashion. And that's why I do recommend either option. And so I will walk through a few examples. Now, of course, anything that I do share in my videos, these are not recommendations. I'm not telling you to go out and buy or invest in these things, just walking through examples so you kind of see how these things work and you can see real life examples, right? It's one thing to kind of walk through concepts when it comes to finance, but when people tend to see things in live in action, it makes it easier to comprehend and you can follow along and see again real life examples. So I'm going to go ahead and stop sharing here for a second. And I kind of want to walk through now, can I share? Oh, wait, that's not what I want to share. I downloaded a couple of things from previous courses that I've hosted, and I wanted to just show them since these are like examples that are readily available. So let's see if I can share that. Share a window, share entire screen. Let me try sharing this window, and if I do that, does it show you guys? Okay, let me stop sharing. I don't think that's gonna work. Okay, hopefully it's going to work. Actually, I can look at my phone real time and see if it is in fact working. So let me swap accounts for a second. And can I see? Nope, that's not what we're looking for, guys. Hold on. I'm trying to set myself up so I can see what you guys are seeing. Okay, I think we're good. Okay, so I'm gonna share my entire screen. Maybe not a screen, just a window. Okay. And let's come here. No, the screen is blank. That did not work how I wanted it to work, guys. Okay. Let's try something else. I already have it opened here. Let's see if I could do it this way. Okay, sweet. I'm just going to share right within Canva. It's fine. I use Canva for a lot of the things that I create. So let's see. Sweet. Okay. Now I just need to make this bigger. How do I get rid of that? Okay. Hold on. Okay, we're here. Fantastic. Okay, so this is a description of what index funds are, right? So basically, as I mentioned before, it's a collection of stocks and or other investments. So with some index funds, they may have things like bonds, they may have some commodities, treasury notes, but most of them are going to be comprised of stocks essentially. And so with index funds, there are many types you can invest in. So, for example, you can invest in index funds or mutual funds. We'll use them collectively in this conversation and discuss the minor differences. That so you can invest in an index fund that has companies that are all within the same industry. So you can invest in an energy index, right? So that would have companies that are all within the energy industry. You can invest in an index fund that's retail based, so it includes all companies. Well, not all, but all of the companies in that portfolio are in the retail industry, and you can do that for pretty much any industry you can possibly imagine. So this is a great tool because let's say you do want to invest in energy, but you're not sure which company to go with. Do you go with Exxon? Do you go with BP? Do you go with Chevron? Right, there's Chevron. Right, there's so many ways you could slice and dice that. But also, many of those companies, their individual stocks are on the expensive side. So it may be out of your budget if you're trying to purchase one individual stock or many stocks. And so this is where an index fund comes into play because it now gives you the ability to diversify the companies you are invested in. You're not worried about finding the perfect stock. And now you are in this industry that you want to invest in. So that's the benefit of going this route when it comes to index funds and trying to invest in an industry. You have other index funds like VOO or SPY. These have companies in many industries. So this particular index or indices, they are comprised of every company listed in the S&P 500. And so this is also a fantastic way to have yourself, in many pots, right? So you'll be able to invest in many industries without overcomplicating it for yourself. And so this is the other great benefit. And it's a simple way to diversify your portfolio essentially. And I tend to look at it as a stress-free way to invest. You don't have to do a whole lot of research. You, of course, want to understand the top companies that are in this portfolio, the industries you will be invested in. Does this pay dividends or not? You do want to understand the basics, but outside of that, it does the diversification for you. And the other great part is companies that no longer meet the threshold of requirements to be in that index, it comes out without you having to do anything, right? So for an example, if a company that used to be on the S&P 500 no longer meets that requirement, the S&P, right, removes that company from the index and may replace it with something else, but you yourself have nothing to worry about. It's all happening behind the scenes for you. So there's that. Now, to the flip side to that, if there are certain industries you're trying to avoid investing in, and you are buying into index funds like VOO or SPY, then that makes things more complicated because as companies are added to that index, if it's in an industry you don't want to be invested in, by default, you are invested in there. So now it becomes a matter of keeping track of those changes if you feel compelled to do so. And then you may want to divest if you don't want to be in that industry. So, one good example, I'm going to stop sharing this little thing here, but I do want to share. Oh, let me X out of this. Okay. I do want to share some things from Yahoo Finance. So let's head there. So SPY, this is one of these index funds I was mentioning that it mirrors the S&P 500. And so one of the companies that was newly added to the S&P 500 is Coinbase. And so Coinbase, as we all know, is a company that is in the cryptocurrency industry, in the cryptocurrency space, essentially. And so that, of course, was a really big deal for the crypto markets. Coinbase, their stock has been doing phenomenally well with that happening. Amongst other things, they have new partnerships, new things that they're doing. Coinbase has been very busy lately. And so if you are someone who is like, I don't want to be in crypto in any shape or fashion, that's not what I believe in for whatever reason, if you do own any index funds that match or mimic the S&P 500, by default, you are now invested in crypto indirectly, but you're in the industry. So something to be mindful of if you are going to go this route. But again, that's like a very rare case, but something to consider. But overall, index funds, mutual funds make it super easy for you to invest. It makes it, in my opinion, low pressure. And, what's also great is if the companies that are in this mini portfolio, essentially, if any of them pay dividends, you will also receive dividends. So again, it's also going to be an income generating asset for you as well. And so, as you guys know, I love to recommend Yahoo Finance. I know this is not sponsored. It's just a tool that I personally do like to use myself. And they just make it super easy to do research, whether you're using their website or if you are using the app. So, for example, let's say you just learned about SPY today and you want to know, well, what companies are in this portfolio? Great question. So, you can literally come here. Sorry, I'm seeing that the screen is blank and I don't know why. Is there a delay maybe? I don't know what's going on with that. On my end, I can see that the screen is sharing. Oh, maybe there is a delay. That is super weird. Okay, as I was saying, so if you were trying to do research on an index fund, Yahoo Finance, great resource to do that. So, very simple. You come to the holdings tab, whether you're on the app, on the website, and it will show you the top 10 companies or holdings that make up this index fund. So as you can see here with the S&P 500, many of these top 10 companies, most of us know and probably are already invested in or are aware of. So you have Nvidia, Microsoft, Apple, Amazon, Meta, Google, Berkshire Hathaway, Tesla, etc. But then the other great part of what Yahoo Finance offers is it shows you the industries, or they call it sectors, that you are also invested in. As you can see, the S&P is it's heavily technology focused, right? But you have financial services, consumer cyclical, communication services, healthcare, energy, utilities, real estate, right? So on and so forth. So this is a very nice snapshot to show you the top companies, the industries that you'll be invested in, and you don't have to too far, right, to kind of figure it out. Now, it does also show the portfolio's composition, and as you can see, the majority of this portfolio is made up of stocks, which is great. Also, when you come to Yahoo Finance, you can always take a look and see about dividends, historical data, and things like that. So for me personally, I like to look at dividend history, right? The historical prices, I can see that in the chart on the summary section, but the dividends piece for me, that's the important part. And so you can see here, if I just look back at the last 12 months, you can see this index fund in particular has paid out a dividend every single quarter. You can see that it increased, then it did decrease, then it increased again. Now, why does that happen? There's so many reasons why, right? So there are companies that are in this portfolio that used to pay dividends that now no longer pay dividends, right? That could be a situation. You might also have companies that have increased how much they are paying in dividends, But then the converse of that is true too. You also have companies that have reduced how much they are paying in dividends. So a combination of all of that is what's going to be the reason or driving factors behind why you see the dividends change quarter over quarter. So as I said before, you see it increase here, it decreases, it increases again, or it could be a situation where a company was on the S&P 500, it wasn't paying dividends, it fell out of the portfolio, they've added a new company in and they pay dividends, right? There's so many moving pieces, but ultimately it's not a major change, but you do see a slight change here. Usually as an investor, you want to see steady growth when it comes to how much companies are paying in dividends when you are looking at an individual company. That's usually what you want to see. Unfortunately, well, maybe I shouldn't say that, but with this situation here, because it's a compilation of companies in here and they all have many moving pieces, seeing this increase and decrease isn't alarming. It's just kind of par for the course. It's part of what happens because every company has their own individual situations. When you compile it together, it gives you this. Not a red flag, but something to be mindful of. So there's that. So let's see. I think there was an energy index that I wanted to show. I always forget the ticker symbol though. Let me look it up here on my phone really quickly. I probably have used this example in the past. Okay, this is a good one. So it's from Vanguard, VDE. It's an energy index. And so this is the example I mentioned before. You want to invest in a certain industry, but you're not sure what company to invest in. So this is where you would find an index fund to help you get into the industry and not worry about finding the perfect company or few companies. So this is an energy index fund. And so if we go to the holdings, we will see here, I'm just making sure things are still showing. Okay, great. Things are still showing on my screen. Fantastic. So the top 10 holdings in this energy index fund, again, companies most of us are aware of or currently use. So you have ExxonMobil, Chevron, ConocoPhillips, Marathon, etc. And then when you look at the sector or industries, it's 99.67% of energy, which is what we expect to see because this is an energy index. So that's fantastic. And then if you look at some of the other metrics that make up this index fund, you can see, where is it? Oh, they show it differently here. That is very interesting. Okay, I'm looking for like dividend yield, but they don't show it that way for index funds. So we can look at the historical data as we did previously and just filter on dividends only. And here you go. You can see that this index has also paid dividends every quarter in the last 12 months, which is great. But the dividend amount has steadily declined. So something that's very interesting to see, but again, not totally shocking. So let's talk about the differences between index funds and mutual funds, because I think that's the piece that a lot of people tend to be confused about. So when it comes to index funds, once that index fund is essentially created, so they determine the metrics that kind of determine what companies make up this mini portfolio, it doesn't really change much. Unless a company just no longer meets that requirement, there isn't a lot of buying and trading with this portfolio. It's kind of like a set it and forget it kind of approach. And so because of that, there are very little fees associated with index funds. So if you look here, you'll see the expense ratio, it's 0.09%. So what does that actually mean? Expense ratio is basically letting you know how much you can expect to pay in fees when it comes to owning or purchasing this index fund, right? And so for me personally, when I'm looking at any index fund or mutual fund, I want an expense ratio below 1%. Now, the reason for that is if I'm paying 1% or more, that's cutting into my portfolio. Well, cutting into my rate of return, right? So you want to keep your expenses as minimal as possible when it comes to investing so you can keep more of the profit. And so this is personal preference. You, of course, can pick whatever ratio feels good for you. But for me personally, I'm looking for something that's less than 1%. Now, with mutual funds, the biggest differences with them versus index funds is mutual funds, they're constantly trading the stocks in that portfolio. And the idea behind that is they're trying to increase or potentially increase the rate of return they are seeing on those investments. And so you have these very well paid hedge funds managers, analysts, etc., who are reviewing charts and data and making decisions on what stocks are going to stay versus go when it comes to mutual funds and their holdings. And there is a cost to that, right? It's not free. They don't work for free. No one does, right? And so because of that, you will be charged a higher expense ratio because of that. And so when you are looking to invest in index funds or mutual funds, that in itself is the biggest difference. It's the matter of how much you're paying in fees and what's being done behind the scenes. So index funds are relatively passive. There isn't much happening there besides making sure those companies meet the requirements to be in that portfolio. Versus mutual funds, there's a lot of buying and selling and trading, ins and outs, and so you have to pay for that. Now, theoretically, you would think that if a mutual fund has these very expensive or well-paid hedge fund managers and analysts who are doing a lot of analysis and they're doing all of this active trading, that they would see some great rates of returns, right? You would think that. That's actually not the truth. All right. So we have found historically that index funds tend to outperform mutual funds over the long term. And so if you are someone who is like, well, I'm willing to pay a little bit more because I want to see a better rate of return, which is why you're sticking with index mutual funds, I get it, but in reality, that's not how the numbers play out. In reality, index funds, while they are more passive, they tend to have better results. So, something to be very mindful of, but essentially, those are the big differences with index funds versus mutual funds. And so, it comes down to just doing your research to understand what industries make up that index fund, does it pay dividends, and also what are you investing in, right? And then also the cost to own said asset. And so something to be mindful of. Now, the other great thing with index funds and or mutual funds is you can buy fractional shares. So if you don't have enough money to buy one full share of this Vanguard Energy Index, you can buy a percentage or portion of it. So lots of flexibility when it comes to investing in either asset. And I think for anyone who is super busy or feels overwhelmed when it comes to investing, this can be a relatively easy way for you to get into the market without overwhelming yourself and having to having to think about picking the perfect stock. And as I said before, there is no such thing as a perfect stock, right? As you move through your investing journey, you're going to have stocks that you pick that are phenomenal. They're doing well for you. You're seeing the growth, is paying dividends, all things are well. You will also have some stocks that don't do too well, right? You invested in it, you thought it would do fantastic, and it's kind of just sitting there. It's not moving much in value, it's not doing much for your portfolio, and it can be kind of anticlimactic. And then the last bucket of stocks you can invest in are the ones that my husband likes to call the dogs, right? And so these are the ones that aren't doing well. You've invested in them, they're losing you money, truthfully, and now you have buyer's remorse. So you will have stocks that you will buy along your journey that fit into one or more of those categories, and just know that is natural. That comes in the journey. Not every stock pick is going to be a home run. That's just the reality of it. Now, are you trying to do your best to increase your chances of picking fantastic stocks? Absolutely. That's the whole purpose of, doing research, reading more books, watching videos like this. But just know along that way, you are going to pick some bad ones. You are. And you have to be okay with that. But then also, when you determine a stock is quote unquote bad, then it becomes, well, what do you do next? Right? You could say, well, the stock price has tanked. This could be a great opportunity to buy more of it because now the stock is on sale. And you believe that down the road, the price will increase, the company will turn things around. And that's like one strategy you could consider. The other side to that is you have to maybe consider cutting your losses, right? You might say, well, I don't want to buy any more stocks of this company. Maybe I should just sell what I have now and take those funds and invest it somewhere else. That's also an option. Or the third option is you don't buy anymore. You don't sell what you have. You just hold it and just see how things play out until some more time has passed. So dogs shouldn't be sold immediately, but you do have to think about what do you do next, right? And the things I just mentioned are the things you should consider before making that decision to buy more or to sell. So there is that. So that is it for today's live guide. Those are the big differences between index funds and mutual funds. Now, if you have any questions and you're watching the replay, feel free to put your questions in the comment section of this video. And I will see all of you guys next week. Take care.